In this video, I'm going to be going through the data to try to identify exactly when this crypto correction will end. I pay a lot for the top crypto and macro research, so we're going to be looking into a lot of the data from a range of experts as to when they think this crypto correction will end. I got the chance to ask Stoic's hybrid intelligence AI model exactly when it thinks that this crypto correction will end. So we have some data from that. I have my own 3 models that I'm building out. And even though they're kind of in early alpha, we're going to dive into kind of when they're saying this crypto correction will end. And lastly, I'll give my overall opinion based on all these things, based on all the things I'm seeing. When do I see this crypto correction ending? When will the pain stop? And when will prices start finally going back up? Keep in mind, this is just my personal opinion. I'm not your financial advisor. None of this is investment advice, and you should always do your own research. Okay, first off, let's dive into what's actually causing the sell-off in the crypto market, because there's a lot of people that are confused about this. This current sell-off that we're experiencing in the crypto market is being primarily driven by macro fundamentals. Things like global liquidity, rate cuts, the Fed, dollar strength, etc. Macro right now is firmly in the driver's seat. And that means when you're looking at your individual alts and you're like, why is this thing not performing? Are they not posting on social media enough? Or maybe they should be doing marketing, etc. I hear a lot of people saying these things, but none of that stuff matters right now because macro is firmly in the driver's seat. They can do all the marketing in the world. They could be posting in their Discord, all they want. That's not going to change the price action because the price action is being driven by macro. So macro is the cause for this current sell-off. And specifically, it comes down to a kind of complicated equation, but I'll try to make it as simple as I can. On one hand, you have Trump who's doing tariffs. He's doing all this stuff with the economy, and it's causing a lot of uncertainty. It's causing a lot of people to not know what's going to come next. On the other hand, you have the Fed, and the Fed wants to make sure that we don't go into a recession, and they want to make sure they get inflation under control. So they're really closely looking at inflation data and making sure it's not spiking up. If they feel like inflation data is peaking up, they're a lot less likely to cut rates. And that's where we saw, people really excited about the Fed cutting rates last year. It looked very bullish for the markets. And then in December, the Fed came out really hawkish. And all that means is they came out really not bullish, we'd call it bearish. They came out really bearish and they were saying, hey, actually, we're not going to get as many rate cuts as, people are expecting. We're only going to plot out 2 rate cuts over 2025. People freaked out. And if you'll notice on the charts, that's at the exact point that the market started going basically down only, was from that date. If you go back into December, you look at that Fed meeting, from that date, markets started going down because, as I've said, this has been primarily a macro-driven sell-off. And the reason the Fed came out hawkish was because inflation was reaccelerating. It looked like inflation was going back up. They don't like that, so they're going to cut less rate, so they're going to do less rate cuts. And that's a problem for markets who need liquidity. We want more liquidity in the markets. Rate cuts give us a ton of liquidity. They give a ton of, think of liquidity as just like the magic dust, the magic liquid that makes the markets go up. We want more of it. And the Fed was saying, hey, you're going to get a lot less of it. So the markets sold off. Now, going back over to Trump wants the Fed to cut rates. We have a lot of debt that needs to get refinanced. We've been doing a lot of short-term refinancing, but we would like to get some long-term refinancing on this debt. We're talking like trillions and trillions of dollars. So Trump wants rates to go lower. Specifically, it's around $7 to $9 trillion that over the next 6 months needs to get refinanced. So you can imagine with an insane amount like $7 to $9 trillion worth of debt needing to be refinanced, Scott Bessent and Trump have put a huge emphasis on trying to find ways so that when we refinance that debt, it's a lot cheaper for us and we're not paying a lot higher rates. You can think of it as like when you buy a home, you want to lock in the lowest rate possible. So that's kind of what the government's trying to do right now. And the easiest way for them to do that is to lower the 10-year yields as far as when it comes to long-term debt refinancing. And the easiest way for them to do that when it comes to short-term debt refinancing would be to lower to get interest rate cut, to get rate cuts. Now, there are a lot of intertwined, really complicated dynamics when it comes to how these things influence one another. And we're not going to dive into that in the scope of this video. Really, the linchpin thing, the problem, the thing causing all the chaos in the markets is inflation. That's what caused the Fed to be hawkish in December. That's what caused the massive sell-off that came after. That's the linchpin here, inflation data. So that's one of the biggest things to kind of keep an eye on. And what the markets want, what we want in order for our bags to go up is to see inflation data cooling off and not accelerating. We don't want to see inflation data going up and reaccelerating. We want to see it cooling off. Now, on one last note, I also think I mentioned the dollar strength index, which is a huge liquidity driver. So the stronger the US dollar is, the less liquidity you have in the markets, and the weaker the US dollar is, the more liquidity you have in the markets. And what we saw immediately after Trump came into office is we saw a huge strengthening of the dollar, which is actually bearish for the markets because, again, it sucks liquidity out of the system. Okay, so that's basically the complicated, weird macro soap opera that we've been watching that's been causing all of us to go through so much pain, the markets to just absolutely bleed and sell off. And, that's kind of like a good general overview. Macro is in the driver's seat right now. Macro is what's causing the sell-off. And until macro gets fixed, your bags are going to keep bleeding. And before we get to what the experts are saying, let's really quick look at each one of these data points for ourselves and see kind of where they're going or the general trend of where they're headed. Over this last week, we got new CPI data that came in a little bit lower than expectations, which is a good thing. So it came in at around 2.8% year over year. And PPI inflation fell as well, coming in below expectations, lower than people expected. Basically, this is the first month where we've had a CPI print and a PPI print, showing that inflation might be cooling off. Looking at the expected rate cuts for 2025 on Polymarket back in February, the consensus was that we were going to get one rate cut in 2025. And I was saying, that's insane. The Fed was just using a dot plot as like a forward guidance mechanism. But if you look at the data, if you look at where inflation is heading, we should have some hot prints, but we're headed lower. And that we were going to get way more than one or two rate cuts in 2025. Well, fast forward to today, and now Polymarket is pricing in 3 rate cuts for 2025, which is a huge increase in the amount of rate cuts that we're expecting from the Fed. And I expect, as inflation data continues to cool down and exceed expectations and show that inflation is in fact not reaccelerating, that we're going to see even more rate cuts priced in from the Fed in 2025. If we look at a chart of the 10-year Treasury yield, we can see that it bottomed over the past year. It bottomed in September of 2024. It peaked around January 13th of 2025, and it's since been on a decline since then. If we look at a chart of the dollar strength index, we can see that it bottomed in September of 2024. It peaked around January 14th, 2025, and it's been on a heavy decline since then. If we look at oil prices, we can as well see that they peaked around mid-January at around $78. And have since been on decline. And if you're wondering why oil prices are in here, that has to do with inflation data because energy is a huge component of inflation. Inflation is just the rate at which things get more expensive. And if you think about shipping things or running an office, everything requires energy. So if energy comes in cheaper, that makes everything in general cheaper, which is a huge component of reducing inflation. Okay, so what are experts saying? I have paid a lot of money for to get access to these newsletters and all of this premium data. So what are these experts saying as far as macro, crypto, etc.? And I'd say the majority of them lean bullish, but it definitely is a mixed bag because there are some bearish voices in there. And I'll dive into the points of each one and kind of what they're seeing. The bearish experts don't necessarily have a lot of strong data to back them, besides the weakening data we saw back in December, January. Outside of that, they're more pointing to the fact that Trump is different this time. He seems to have a lot more willingness to crash the markets. He seems to want to front load the pain in the markets when it comes to equity selling off, or when it comes to stock market selling off. He doesn't seem to mind that like he did in his first term this time. And a lot of them are kind of theorizing that basically Trump wants to front load as much pain as possible early in his term because it's a lot easier to blame it on the previous administration, so that he can have a better, cleaner next 3 years. So he can kind of get his the financial situation in order, front load that pain, crash the markets, and then from there it's up only. And some of them will point to the fact that we have all this debt that needs to be refinanced. So we really need to get this 10-year the 10-year down. We really need to get rate cuts or 10-year or something needs to happen in order for us to refinance this debt in favorable terms, whether that's short term or long term. Ideally, we would like to refinance. We've had a lot of debt that we've been refinancing short term. Ideally, we need to do this long term and kind of lock in lower rates. And it seems like, according to them, that Trump is willing to do whatever it takes, including crashing the market, to make this happen, because in his mind, it's short-term pain for long-term gain. And so the reason they're bearish isn't necessarily like long-term bearish. It isn't necessarily like, oh my gosh, the data is going to be horrible. We're going to like a really long-term recession. It's more like on the short term, there might be a lot more pain that we have to go through before things turn around. Now, that's what the bearish experts say. Here's what the bullish experts say. They point to the fact that the growth scare that we saw in prior months seems to be massively reversing. And I've actually heard a really strong argument that a lot of the numbers that were coming in related to that growth scare had to do with the fact that, people were fearful of tariffs. So we saw a lot of like rapid, importation of needed materials before tariffs came into place, because people wanted to prepare for like, oh my gosh, tariffs are going to come into place. We want to import these materials ahead of schedule. And that spiked certain data points that made people think, oh my gosh, we're heading into a recession because, look at this data. But really, it was just people front running tariffs. I don't know if that's exactly the case, but we do see the data around the growth scare reversing. On another front, we see the dollar strength falling. We talked about how that's really bullish for the markets, because that means more liquidity goes into the markets. I've talked about in the past why that is and kind of the relationship between liquidity and dollar strength. But the only thing you need to know is we looked at the chart earlier. You can see dollar strength has been falling off an absolute cliff, which is a really good thing for the markets. They point to oil prices falling. So that's good for inflation. And what's good for inflation is good for rate cuts. And what's good for rate cuts is good for liquidity. And what's good for liquidity is good for our crypto bags. They point to the fact that the 10-year is headed the right direction. We were previously going higher, and now we're at least on a decline. And lastly, they point to the fact that CEO confidence data is surging, which means that CEOs seem to be confident in growth and hiring, et cetera, which is good for the economy. And M2 is surging. So global liquidity, global M2 is heading higher. All of those things, in their opinion, mean that we're headed into more bullish territory and that the market should actually be reversing soon and heading higher. Now, I still have my own model data to share, my own personal take, wrapping it all together, what I believe is coming next and when I believe this correction will turn around. We still have Stoics data and Stoics prediction on when this whole situation will turn around, as well as a ton more. But really quick, the Obsidian Council is my private research community where I share monthly research, my entire portfolio, buy and sell alerts whenever I buy into a project, and more. We've had projects go up 1,100%, 1,200%, 1,500%, and some much more. I spend a lot of money to access a variety of newsletters, private groups, and more so I can get the best alpha in the market. And I share that alpha with the members of the Obsidian Council. Currently, the Obsidian Council is sold out and closed to new members. But if you want to join next time it opens up, make sure to join the waitlist in the description of this video. Okay, so I was given another chance to ask Stoics Hybrid Intelligence really specific questions on when it thought the market would turn around, at different points on macro, etc. The first question I asked was when they thought we would see alt season, because obviously for us to get an alt season, macro, the macro picture needs to improve, crypto needs to turn around, and I think a lot of us just really care about alt season because we have a lot of, we got heavy alt bags. So, if Bitcoin came back and the stock market came back, I think we'd be happy, but not as happy if we had an as if we had an alt season. And so I asked it, when do you think we're going to have an alt season? And the answer it came back with was August 2025. So according to Stoics, hybrid intelligence model, August of 2025 is when we should see alt season. Now, the second question I asked the hybrid intelligence was how many rate cuts we would get this year. And they actually came back with a surprising answer. And they said only 2 rate cuts this year, which obviously I personally disagree with. I think we're going to see, 3, 4, 5, more rate cuts in 2025, but their hybrid intelligence model came back with 2. Surprisingly, almost contradicting that point, they expect CPI to reach a low in 2025 of 1.96%, which is under the Fed's mandate, which would mean the Fed would be, if it were to hit that level, the Fed would be absolutely free to cut a lot more over 2025. But yeah, those are the 3 forecasts that they gave. Now, I do have 3 macro models that I'm building out myself. These are based on a ton of different macro indicators like dollar strength, M2, 10-year, etc., dating back decades and looking at the patterns between those things and the relationship between those things and Bitcoin. These are still in really early alpha stage of testing, so I wouldn't give a ton of weight to this data, but I thought it'd be fun to share the results as well. The crypto 90-day expansion model is showing that crypto prices should be higher in the next 90 days. And it's saying a major movement up over 95,000. So this was priced at when it was $79,000. And it's saying over the next 90 days, we should see a major move up where prices go at least over $95,000. And the Bitcoin all-time high prediction model is showing an all-time high for Bitcoin this year of around $169,000. It's saying it could range between $117,000 and $200,000, but kind of the price it settled on was 169,000. Again, I wouldn't give a ton of weight to either of these predictions, but they do seem in line with what we're seeing from, maybe some of these other experts and some of the data that we've looked at previously. Okay, bringing it all together, my thoughts after looking over all this research, looking at, all this data, where do I think the market is going from here, and when do I think this correction will end? First off, there's a lot of fear around recession that's driving a lot of fear in the markets, and I think this fear is unwarranted. And the reason I think this fear is unwarranted is because the Fed currently has a lot of ammo to throw at the market if we were to go into any sort of recessionary territory. The only thing that would hold them back from deploying that ammo would be inflation data. I'll get into that in a second. And why I don't think that's going to be an issue. But right now, the Fed could cut rates. There's a substantial amount of room for the Fed to cut rates. It's not like we're sitting at 0% rates currently. We're sitting pretty high right now, and they have a lot of wiggle room when it comes to cutting rates and injecting liquidity into the economy to offset any sort of recessionary data that we could see as far as unemployment, et cetera. On top of that, that's not even counting the fact that, right now we're in QT. Once rates hit zero, they could start doing QE as well. So we could cut rates all the way down to zero. Then they could start doing QE. They have so much ammo when it comes to offsetting any sort of recession or anything like that. I really don't think that's an issue. I think as far as markets are concerned, that's kind of a nothing burger. And if we start to see unemployment tick up, et cetera, it's almost bullish in my book. It's almost bullish because that just means the Fed's more likely to cut and inject that liquidity into the market. And we know what Bitcoin and crypto does when that happens. Now, as far as inflation, I've already shown you that oil prices are on the decline, and there's a lot of other reasons to believe that inflation is on the decline. But one of the most interesting examples of maybe where inflation data is going is looking at trueflation, which if you historically look at, the correlation between trueflation and future CPI prints, there seems to be like around a 45-day lag. Basically, trueflation data front runs CPI data by around 45 days. And if you look at it, you can see that trueflation data started heading up around September. So around September 2024, and then it peaked around December 13th. So around the time we actually got that really hawkish Fed meeting, we saw inflation data on trueflation peak. And again, this data seems to kind of front run CPI data by around 45 days on average. And trueflation put out this really cool video where they actually showed that this is correlated and that trueflation does front run CPI data lags trueflation data by 45 days. And you can actually see that the most recent inflation print was at this peak of recent trueflation data right before it fell off a cliff. So actually the bullish inflation print that we just got was around the peak of, not the peak, but the cliff edge, right before inflation data on trueflation fell off a cliff and went from 3% all the way down, bottoming all the way down at 1.3%. And if that's accurate, if trueflation is actually correctly pricing the direction where CPI data is about to go, that's extremely bullish for the markets, because if we were to go under 2%, or even if we were to just show that the markets are on decline when it comes to inflation, that would give the Fed ammo to start pricing in more rate cuts for 2025, which would be extremely bullish for the markets. As we've noted, looking at the data, looking at the expert takes, etc., macro data is heading the right direction. Like it's looking good. And I would actually say a lot of the fear, a lot of the problems in the market right now aren't necessarily like hard, negative macro data. They're actually a lot of uncertainty and just fear in the market. It's just fear and uncertainty in the market. A lot of unknown, a little bit of chaos sowed by Trump. That's really what's leading to the market selling off. People saying, hey, we don't know what's going to come next. We don't know if it's going to be bad or good. So we want to risk off, get out of the markets just in case it is bad. But as you can see, the data actually isn't bad. The data is actually looking good, and it's getting more and more bullish. So once you clear up that uncertainty, that allows the markets to then resume heading back up. And in my opinion, that's what we're going to see. As soon as we clear up this uncertainty, we're going to see the markets start heading back up. You also got to remember that markets top when you run out of buyers, and markets bottom when you run out of sellers. And there's going to become a point in the market. There's going to come a point when the market runs out of sellers. When the level of pain that we're hitting, the threshold of pain we're hitting, cannot trigger any more sellers. And it takes substantially more pain in order to introduce a new wave of selling. We also have the SLR exemption, which I talked about a few weeks ago. If that were to come into play, that would be really good for the 10-year. We have China stimulus coming into the market. As the dollar weakens, they're given more room to stimulate their own economy, which they desperately need to do. We have central banks globally entering cutting cycles. So we have a lot of central banks globally cutting rates, which again is injecting more liquidity into the global liquidity markets. We have tax cuts in the U.S. where Trump's talking about eliminating taxes for anyone under $150,000 in income, plus a whole bunch of other tax cuts and all that kind of stuff, which those are, again, liquidity injection events, and a ton of other bullish factors. They just lead me to believe, especially when you look at crypto, like the amount of bullish factors around crypto are insane. Absolutely insane. If you look at the just pure crypto picture, take macro out of it, it's insanely bullish. So when you look at all these factors together, it points towards a really bullish picture that's simply obscured by a lot of fear, uncertainty, and doubt in the market, and a little bit of chaos, again, from Trump doing new things that people aren't expecting, and they're just not sure what to do, so they're de-risking from the markets. And on the last point, as I said, I expect the Fed to cut more than 4 times, or 4 or more times. So currently, the poly market's now up to 3, so we're getting closer to what I've been saying. 1 more and we're at 4. Okay, so 4 or more times is where how much I'm expecting the Fed to cut rates in 2025, because I expect CPI to be tamed and all of that. The next catalyst is going to be the Fed meeting on Wednesday. I don't know that necessarily anything will happen if they're as long as they're just like normally dovish. If the CPI print from last week's any indication, really nothing should happen. It'd be awesome if it did, but the CPI print was really bullish, didn't seem to move the markets. So if they were just kind of normally dovish, I don't see it doing anything. If they come out with like, some sort of like crazy over the top dovishness, which is like basically like we're going to cut a ton of rates, or I don't know, the economy is doing insanely good, something like that, maybe the markets react. Or if they were to come in hawkish at all, we'd probably see the markets react to the downside. So that there is a little bit of catalyst risk from the next Fed meeting. But in my opinion, long term, none of this stuff matters because crypto is going to $100 trillion market cap. We are still insanely early. We still have so much room to go. Macro is painting a cloudy picture right now. We have a little bit of bumps in the road, but this is par for the course when it comes to crypto. Crypto is a volatile asset class. It's further out on the risk curve, higher risk, higher reward. And so in periods like this with downside, you're going to just experience more of a downside. But when the bullish period enters, that's when it pays to be in the crypto markets. And I believe crypto overall is like, when you look at the big picture, is going to be up only over the next decade. Make sure to sign up for my free weekly crypto newsletter. It's mostly just all my content I put out each week in an easy email so you don't miss it. But occasionally I drop some other cool stuff in there as well, including sometimes I mention things I'm buying before I ever talk about it on my YouTube channel. Also, if you really want to dive deep, make sure to check out my weekly podcast, the 1 to 1 Million Podcast. I interview projects, talk about the markets, and interview various traders and experts in the crypto space. As always, none of this is investment advice. None of this is me telling you to buy crypto or do anything. I'm not your financial advisor. I'm just a guy on YouTube who has his entire life savings in crypto and really pays attention to a lot of stuff because I don't want to be poor. If the video is helpful, make sure to hit that like button. If you have any questions or comments or anything to add or any bullish catalyst, bearish things you're worried about, let me know in the comments below. If you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.